Hello intelligent investors, this is Victor here. If you have been following Disney stock recently, you will know that Disney has largely underperformed the S&P 500 index in the past 1 year. Disney stock has dropped as much as 23.7% from its recent peak. Disney reported a much lower than expected Disney Plus subscriber growth in Q4. This is why Disney stock has dropped as much as 12% right after its Q4 earnings release. Obviously, Disney's business is still recovering from the pandemic. In this video, I'm going to analyze Disney stock to see if it's a great company for long-term investing. I will talk about these topics in this video. First, what is Disney's business model? You will learn about Disney's most important businesses and how it earns its revenues. Second, Disney's most important growth catalyst, Disney Plus. Third, Disney's second growth catalyst, Disney's parks recovery. Fourth, Disney's two main risks you must know. Fifth, Disney stock valuation. You will learn about whether Disney stock is overvalued, fairly valued, or undervalued. And sixth, will I buy Disney stock? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we'll be able to stay independent, hire other outstanding analysts to cover different stocks, and create many excellent stock analysis and investing videos every week that will help you become a great investor. The link is in the video description. Take a look, let's start. Before talking about Disney's business model, let me share with you this quote from Benjamin Graham. Benjamin Graham said this in his most famous investing book, The Intelligent Investor. Investment is most intelligent when it's most business-like. This is why I believe it's important to understand the business first before investing in any stocks. Disney has many services including Disney Parks, Disney Resorts, Disney Cruise Lines, broadcast TV networks, Disney streaming services such as Disney Plus, ESPN Plus, and Hulu, Disney merchandise based on its own IPs, movies and shows from Disney, Pixar, Marvel, Star Wars, National Geographic, and 20th Century Studios. Disney earns its revenues from two main business segments. First, Disney Media and Entertainment. Second, Disney Parks and Experiences. If you look at Disney's most recent Q4 earnings release here, you can see Disney earned much more revenue and operating income from its media and entertainment business than its Disney Parks and Experiences business. Within Disney's media and entertainment business segment, Disney earns the most revenue and profit from its linear network business. Disney's linear network business includes its domestic and international cable networks such as Disney, ESPN, National Geographic, ABC Broadcast TV Network, and 8 other domestic TV stations. In the full year fiscal 2021, Disney's linear networks business had an operating income of $8.4 billion compared with direct-to-consumer DTC's operating loss of $1.68 billion. During the same period, Disney's total segment operating income was $7.8 billion. This means Disney's linear networks business is the most important business that contributes the most revenue and operating profit for Disney now. Disney Parks and Experiences business is not fully recovered yet as shown here. You can see Disney Parks and Experiences business only contributed $471 million of operating income in fiscal 2021. Obviously, Disney's theme parks and resorts business is greatly impacted by the current pandemic. Disney had to shut down its theme parks, resorts, and cruises for many months since the pandemic started in early 2020. Now Disney is starting to reopen its Disney parks and resorts again, but Disney can only operate them at a reduced capacity until regulators allow Disney parks and resorts to run at a full capacity again. Disney's direct-to-consumer DTC is another important business you will want to know about. This is Disney's streaming business. In the most recent Q4 quarter, Disney had 179 million paid subscribers across Disney Plus, ESPN Plus, and Hulu. Disney Plus had 118.1 million subscribers, up 60% year over year. ESPN had 17.1 million subscribers, up 66% year over year, and Hulu had 43.8 million subscribers, up 20% year over year. This shows that Disney has a lot of growth potential in its direct-to-consumer business. In comparison, Netflix had 240 million paid subscribers during the same period. Disney's biggest competitive advantage is its own intellectual properties. Disney owns some of the most valuable IPs in the entertainment industry, including Disney characters, Pixar movies, Marvel characters such as Avengers, X-Men, Star Wars, National Geographic, The Simpsons, Family Guy, and many other IPs from 21st Century Fox. Disney is now the majority owner of Hulu streaming service after it acquired 21st Century Fox in 2019. In terms of financial, Disney is still recovering from the pandemic. If you look at Morningstar here, you can see Disney's revenue was growing consistently almost every year before the pandemic in 2020. Disney's diluted earnings per share were also growing consistently almost every year before 2019. Here's the important part you want to know. Disney had the highest free cash flow of $9.83 billion in 2018. In comparison, Disney only had a free cash flow of $1.988 billion in fiscal 2021. This means Disney's businesses still have a long way to go to return to full capacity. I will talk more about this later on. When it comes to investing, we have to be forward-looking. So let's talk about Disney's two most important growth catalysts going forward. I believe Disney's most important growth catalyst will be its direct-to-consumer DTC business. I believe Disney Plus will have the biggest growth potential over the next 10 years, compared with Disney's linear TV networks and Disney's theme parks and resorts business. As of now, Disney Plus is not profitable yet. Disney still needs to spend billions in new content every year to grow its paid subscribers. Disney's management said this in the recent earnings call. I want to reiterate that we remain focused on managing our DTC business for the long term, not quarter to quarter, and we're confident we're on the right trajectory to achieve guidance that we provided at last year's Investors Day, reaching between 230 million and 260 million paid Disney Plus subscribers globally by the end of fiscal year 2024, and with Disney Plus achieving profitability that same year. In the most recent Q4 quarter, Disney had 179 million paid subscribers across Disney Plus, ESPN Plus, and Hulu. Disney Plus had 118.1 million subscribers, ESPN had 17.1 million subscribers, and Hulu had 43.8 million subscribers. In comparison, Netflix had 240 million paid subscribers during the same period. Here is Disney's strategy to grow its Disney Plus subscribers base from 118.1 million in 2021 to between 230 million and 260 million by fiscal 2024. Management said this in the Q4 earnings call. In total, we're nearly doubling the amount of original content from our market brands Disney, Marvel, Pixar, Star Wars, and National Geographic coming to Disney Plus in fiscal 2022, with the majority of our highly anticipated titles arriving July through September. This represents the beginning of the surge of new content shared last December at our Investor Conference 2.0. We recognize that the single most effective way to grow our streaming platforms worldwide is with great content, and we're singularly focused on making new high-quality entertainment, including local and regional content that we believe will resonate with audiences. Of note, we have 340 plus local original titles in various stages of development and production for our DTC platforms over the next few years. If you look at Disney's recent Q4 earnings release here, you can see Disney's direct-to-consumer DTC business was the only business that had double-digit revenue growth of 38% year-over-year in Q4. In comparison, Disney's most profitable business, linear networks revenue decreased 4% year-over-year, and content sales grew only 9% year-over-year. Disney Parks and Experiences business is still operating at a reduced capacity at the time of making this video, so this growth here is not meaningful. Disney will focus on growing its direct-to-consumer DTC business going forward because this business has the largest growth potential compared with other business segments. Consumers are cutting their cable networks and moving to online streaming much more than before. Netflix is the market leader in online video streaming. Netflix has been growing at a much faster rate than Disney in the past 10 years. Going forward, Disney will be investing a lot more capital to grow its local and international content. Disney will use its own IPs such as Disney characters, Marvel Avengers, Pixar, and Star Wars to continue growing its original content. This is very similar to Netflix's original content strategy. Disney's management said this in the recent earnings call. As you know, we announced our last Investor Day that we expect our total content expense to be between $8 billion and $9 billion in fiscal 2024. And we will now be increasing that investment further with the primary driver being more local and regional content. We're expanding our global reach by introducing Disney Plus in additional markets around the world. In the short term, Disney Plus subscriber growth may have slowed down in recent quarters because Disney has not released enough new content recently. But in the long term, I believe Disney Plus will eventually reach between 230 million and 260 million subscribers by the end of fiscal 2024 or later. Because Disney will be investing much more in original content going forward, that's based on Disney characters, Pixar, Marvel, Star Wars, and IPs from 21st Century Fox. Again, this content strategy is very similar to Netflix's original content strategy. I believe Disney's second most important growth catalyst is Disney Parks and Resorts eventually returning to full capacity. Disney's theme parks, resorts, and cruises are greatly impacted by the pandemic because they are not allowed to operate at a full capacity yet until regulators around the world lift COVID-19 restrictions and until regulators allow cross-border traveling again. In my opinion, I believe it will take some time before everyone is fully vaccinated and before many Disney customers are comfortable enough to go to Disney parks, resorts, and cruises. The most important question is how long will it take Disney Parks and Resorts to return into full capacity again, similar to its full capacity in 2018 and 2019. I cannot predict the exact time, but I believe it will take Disney about 5 years to return to full capacity again, assuming there are no more COVID-19 variants over the next 5 years. Here's the interesting part you want to know. When Disney Parks and Experiences business was operating at a full capacity, this business segment had revenue of $26.2 billion and an operating income of $6.76 billion in fiscal 2019. In comparison, this same business segment had revenue of $16.6 billion and an operating income of $471 million in fiscal 2021. This means we should expect Disney Parks and Resorts business will eventually earn at least the same amount of revenue and operating income once regulators allow Disney to operate at a full capacity again and once cross-border traveling is back to normal again. Personally, I believe it will be a matter of time before Disney Parks and Resorts business returns to full capacity again. Let's talk about Disney's two major risks you must know about. I believe Disney's biggest risk in the short term is its slowing Disney Plus subscriber growth. Disney stock has dropped a lot recently because its recent Q4 quarter showed that Disney Plus subscriber growth has slowed down much more than many analysts had expected. The main reason is that Disney has not released enough content recently. Personally, I believe this is a short-term risk. I believe the market overreacted. I talked about this earlier. Similar to Netflix's original content strategy, Disney will be investing much more in original content that will be based on its own IPs going forward. Creating more content such as Marvel adventure movies and shows for Disney Plus will require a lot of investments upfront. This means Disney will likely not have as much free cash flows as before until Disney Plus becomes a profitable business. For example, this is from the recent Q4 earnings release. Cash provided by operations for fiscal 2021 decreased by $2 billion from $7.6 billion in the prior year to $5.6 billion in the current year. The decrease was due to higher spending for film and television content and cash tax payments, partially offset by a favorable working capital impact as net working capital liabilities declined in the prior year as our business activities were suspended and increased in the current year as our business activities return. Disney is aiming to grow Disney Plus subscribers from 118.1 million in fiscal 2021 to between 230 million and 260 million by fiscal 2024. This means we can expect there will be a lot more content investments and lower free cash flow for Disney going forward until Disney Plus becomes a profitable business. I believe Disney's second biggest risk is obviously the current pandemic that is still affecting Disney's theme parks and resorts business. Management said at the same time, the US government's approval of vaccines for 5 to 11 years old and the reopening of borders to fully vaccinated international travelers are both important steps toward the recovery of our business. However, keep in mind that due to longer vacation planning lead times, we don't expect to see a substantial recovery in international attendance at our domestic parks until toward the end of fiscal 2022. If the pandemic continues to be longer than expected or if there are more COVID-19 variants, Disney Parks and Resorts will not be able to return to full capacity. Also, it will take time for everyone, including kids, to be fully vaccinated. So all these external factors can delay Disney's businesses to return to full capacity. Let's talk about Disney stock valuation. I always use this intrinsic value calculator here to calculate a stock's fair intrinsic value, so I will know whether the stock is currently undervalued, fairly valued, or overvalued. If you want this calculator, you can download it in my Patreon blog in the video description. Here are the key assumptions. First, I define Disney's intrinsic value as its future cash flows discounted to the present day. The discount rate is 8%. This is slightly higher than the 7.6% cost of equity calculated by Finbox.com. If you want to be more conservative, you can always use a higher discount rate here. Disney's most recent trailing 12 months of free cash flow is $1.988 billion. You can find this in Disney's most recent earnings release. To calculate the terminal value at the end of year 5, we're using both the perpetual growth model and the exit multiple model here. Then we take the average of both models to calculate the terminal value. Now here's the important part. There are 3 case scenarios: the worst case, the normal case, and the best case scenarios. All these scenarios assume Disney's theme park and resorts business will return to full capacity again over the next 5 to 10 years. This means Disney's free cash flow growth should grow a lot during this period. Also, these 3 case scenarios assume Disney's free cash flow will eventually grow over $9.83 billion. Disney had the highest free cash flow of $9.83 billion in 2018. Let's go over these 3 case scenarios. I will start with the best case scenario first. Under the best case scenario, we're using a compound annual growth rate CAGR of 40% over the next 5 years, and then we're using a CAGR of 15% afterward. This means Disney's free cash flow will reach an all-time high again in about 5 years. If we forecast Disney's free cash flow to the next 10 years and discount the free cash flow to the present day, Disney's interest value should be around $332 billion for the entire company, or $183 per share. I'm giving this scenario a 50% probability here. Under the normal case scenario, we're using a compound annual growth rate CAGR of 30% over the next 5 years, and then we're using a CAGR of 15% afterward. This means Disney's free cash flow will reach an all-time high again in about 7 years. If we forecast Disney's free cash flow to the next 10 years and discount the free cash flow to the present day, Disney's interest value should be around $260 billion for the entire company, or $143 per share. I'm giving this scenario a 25% probability here. Under the worst case scenario, we're using a compound annual growth rate of 20% over the next 5 years, and then we're using a CAGR of 15% afterward. This means Disney's free cash flow will reach an all-time high again in about 10 years. If we forecast Disney's free cash flow to the next 10 years and discount the free cash flow to the present day, Disney's interest value should be around $207 billion for the entire company, or $114 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Disney's fair intrinsic value should be around $156 per share at the time of making this video. This means Disney, in my opinion, is likely fairly valued or slightly undervalued at the time of making this video. Just to compare, Morningstar estimated Disney's fair intrinsic value to be much higher at around $170 per share. So will I buy Disney stock? This may surprise you. I will not buy Disney stock now, even though it's likely undervalued at the time of making this video. The main reason is that Disney Park and Resorts business is very cyclical. Disney Park and Resorts business can be easily impacted by the pandemic or other external circumstances. To be fair, I believe Disney Park and Resorts business will eventually return to full capacity again. This means Disney will eventually return to growth again. I also believe Disney Plus subscribers will eventually reach between 230 million and 260 million because Disney is investing a lot more in original content using its IPs going forward. This is just my personal preference. I prefer to invest in companies that are less cyclical and that have higher growth rates. For example, I prefer to invest in Apple, Microsoft, Google, Amazon, Tesla, and Nvidia. Now all these are only my opinions and my analysis based on my research. They are not financial advice. As always, make sure you always do your research and do your extra due diligence first before investing in anything. It's important to always invest in what you know. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we'll be able to stay independent, hire other outstanding analysts to cover different stocks, and create many excellent stock analysis and investing videos a week that will help you become a great investor. The link is in the video description. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.